It seems like we'll always be talking about rates.
Yeah.
Usually they're a little bit more steady Eddie. It's not a huge story. And then it was inflation. Well, really we were talking inflation, material cost was rising, single family homes. Now it's all about interest rates.
It's interest rates as an equation for the larger economy and as a factor into the housing market. And then there's also, I think we also have been talking a lot about the kind of specific application of interest rates in the apartment market, which is like the direct, how's it going to affect the math that you do and how you structure a deal. But this made me think and really got me down several rabbit holes about what does the interest rates of today and the economy of today look like, specifically housing sales, but how does that compare with the early 80s and the Great Financial Crisis? Mm-hmm. We covered this in an article from Investec last week, but this one has some additional relevance for multifamily investors specifically. So I appreciate this and the subject matter for sure.
So what were some of the conclusions, Matt? I guess that Berkadia made, and then let's go to the other source. We're looking at some more historical data. I mean, just to read the headline, today's soaring mortgage rates and declining home sales trends mirror periods before a crash. I don't like the sound of that.
Yeah, so it's basically positing and pretty compellingly that this is certainly rhyming with these two moments. We saw it before, but it's like interest rates go high, home sales go low. And my question is then, how similar is this to the points in the past, and where might we be compared to the past? Are we on the way up? Are we on the way down? The strength of previous crashes, are we in for something that's that strong, or are we in for interest rates that are that high? I'll tell you one thing that I learned is that the interest rates did not behave. The interest rates were crazy in the 80s, not so crazy in when it comes to the Great Financial Crisis.
Mm-hmm. So they increased, but wasn't. But we didn't have. It wasn't not for the necessarily the same issues. They're trying to cool the economy down a little bit, but not. It wasn't the crazy inflation.
The inflation environment was different, and the kind of underlying fundamentals, especially financing of housing in general, was different. So
that's what I was going to say. As much as you never want to say, well, this is just different. We have to ignore the past. There are some fundamental differences. The way the foundation, the bedrock of the economy, the changes in banking laws and the risk that banks can take, as well as the way housing has been financed over the last cycle of, very few floating rate or adjustable mortgages. People are actually having their credit checked. People are credit worthy to buy them. And then we have all these people, home buyers, who've either bought a home or refinanced at incredibly low interest rates. So they're not going to have necessarily the pressure to sell that was caused back in 2006, 2007, leading to the Great Financial Crisis as interest rates rose. The teaser rates and the rates on their adjustable mortgages, went from, you were paying a 3%, now all of a sudden you're paying a 6.5%, and people couldn't afford double the mortgage payment. Then they would default, and then they lost their job at the same time as unemployment was high. So there's a lot of differences between now and then, but we can't ignore that. Is there some rhyming? And maybe the downturn isn't going to be as painful, but the market's still going to be affected. There's still going to be some pain and some losses, whether they're realized or not. I think that's the big question.
So there was a link from Mortgage News Daily that has everything really neat and clean when it comes to comparing 30-year mortgage rates. You can really see where the drama happened in the early 80s, where the drama happened in the mid to late 2000s, and then where we are now. In both the 80s and 2000s, when interest rates fell, they fell quickly, but the run-up in interest rates was much, much steeper in the 80s than it was in the mid to late 2000s. And I think our current situation, both in terms of mortgage rate trends and general economic trends, is much closer to the 1980s than the late 2000s. Mortgage rates are increasing at close to the same speed now as they were in the early 80s. The Fed started their interest rate increases in March. If we were to follow the same path as the early 80s, we're about halfway there. The relevant stretch of mortgage rate hikes in the early 80s was about a 6% increase. Currently, mortgage rates have gone up about 3% between December 2021 and now.
So the question that I would be curious in going back on learning is, the makeup of mortgages back in the 80s were those mostly fixed or floating, because we know back in 2006 to the great financial crisis, a lot of those were variable. Now now we see more fixed rate, 30-year fixed, 30-year, 15-year fixed versus variable arm. Those are the questions I have of like, what's the breakdown of the mortgages, and to see, is this time different? That's what we're trying to figure out.
Yeah.
Is like, are we going to have an analog, or is just the differences in the economy and the housing market going to allow for some kind of easy, soft landing?